Hi, everyone. Thank you for joining the 2019 Manager Spotlight for Santa Barbara. Today we're going to focus on dividend growth investing, kind of give a high-level overview of the firm and some of the strategies and kind of how they operate. So with that, I'm going to let Eric Airway take it away. So thanks very much, Eric.
Thanks, Patrick, and thanks everybody for your consideration and interest in the dividend growth strategies at Santa Barbara. Thought I'd just give a quick overview of the firm, what it is that we do, more importantly, what makes us different than other dividend strategies, and how we're kind of positioned for the current market environment. First and foremost, we are a wholly owned subsidiary of Nuveen. We manage just under $13 billion in assets across our domestic, global, and international strategies, but it's all managed by the same investment team using the same investment philosophy, which is a dividend growth investing philosophy. So dividend growth investing is all that we do at Santa Barbara. We have a 7-person investment team, which is led by our CIO and portfolio manager, Jim Booth, who created the strategies. And every member of the team, including Jim, is an analyst that's responsible for a particular industry or a particular sector. And we are essentially conducting bottom-up fundamental analysis to identify companies that have what we believe the ability to grow their dividend well into the future. And there's a number of reasons why you would focus on, or why we focus on dividend growth as our core philosophy. There has been a lot of empirical research done that shows over long periods of time companies that have the ability to grow their dividend have been able to generate much better returns than any other segment of the equity market, and they've done so while taking on less risk as measured by standard deviation. So essentially over full market cycles, you are able to get the best risk-adjusted returns by focusing on companies that have the ability to grow their dividends. And this chart here by Ned Davis shows just the powerful impact of dividend growers over the last 40-plus years on a risk-adjusted return basis. But I would argue the other reason that we really focus on it, dividend growth as our core philosophy, is that when you think about the fundamental factors that you are trying to identify when you're looking for a company that can sustain dividend growth, we find it to be just the most efficient way to identify what we believe are very, very high-quality companies that you would want to own for a long period of time. So our analysis is really trying to identify those companies that have a true demand for their product or service, the ability to grow earnings and revenue in all market environments, good free cash flow acceleration, margin expansion, healthy balance sheets. But what often gets overlooked is the management teams. We spend a lot of time evaluating the management teams of these companies, making sure that they have a solid track record of capital allocation, that they have a true commitment to returning capital back to the shareholder, and really trying to identify that they have been able to execute on what it is they said they were going to do in the past. And so when we can identify what we believe are high-quality management teams that have their interests aligned with the shareholder, and they are running a company that has the fundamentals that we believe allow them to grow their dividend, and these companies are trading at reasonable valuations, these are the types of companies that we look to add to the portfolio. At the portfolio construction level, we try to construct a portfolio using 3 construction principles. And so what we're trying to do is make sure that the overall dividend growth rate for the portfolio is going to be above that of the dividend growth rate of the S&P 500, which is our benchmark. We do represent every sector, which is why we like to highlight this, because there are definitely certain sectors out there that are not going to provide very high dividend growth rates. So we just try to make sure that at the portfolio level, that we will make sure that the dividend growth rate will be well above that of the S&P. We try to maintain a beta below 1. As I alluded to earlier, most companies that can sustain dividend growth have really good downside protection and usually provide really good risk-adjusted returns. We just feel by having a portfolio beta below 1, it helps mitigate some of the day-to-day volatility and really helps with downside protection. And then as a dividend strategy, we feel we should be able to have a dividend yield that's at least equal to or greater than the S&P 500, especially when you consider roughly 18% of the S&P 500 doesn't pay a dividend. However, we are very much first and foremost a total return focused strategy. So we're not targeting a specific yield. We do invest in below market yielders, but at the portfolio level, we will maintain a yield that is at least equal to that of the S&P or higher. And the overall objective of this strategy is to outperform the S&P 500 over full market cycles and do so while taking on less risk than the market. And since inception, we've been able to achieve that. Since inception of the portfolio in 2004, we've actually annualized about 316 basis points of alpha over the S&P gross of fees, and we've achieved that by capturing roughly 94% of the upside and limiting downside to about 70%. And so by participating in a meaningful way in the equity markets when they're going up and really limiting the downside volatility, we've been able to really generate a lot of excess returns. And you can see here, based on the eVestment large cap core peer group percentile rankings, we rank very high on annualized return, lower volatility as measured by standard deviation, downside capture, and all of that results in very good risk-adjusted returns, which shows us in the first percentile for Sharpe ratio relative to the peer group. And a lot of this, I think, is achieved by what makes us different, what sets us apart. And the two major factors that I think really differentiate us from most other dividend strategies have to do with lack of constraints around how we invest. When I look at the peer group, almost all dividend managers, whether it's a large value or a large core, whether it's a higher yielding manager or a dividend growth manager, almost every dividend strategy has some level of a yield bias, whether it's an initial screen that requires every company to yield above the S&P 500, or it's a mandate that the portfolio is going to target a 4% dividend yield or a 5% dividend yield. Almost every dividend strategy has some mandate that focuses very heavily on yield. And we are, again, a dividend growth strategy that focuses more on total return, and we are willing and do invest in below market yielders. And you can see on the left-hand side of this slide, the dark shaded blue area indicates the percentage of our portfolio invested in companies that yield less than the S&P 500. It's roughly about 25% of our holdings. And this allows us to invest in companies that you will not find in most other dividend strategies, companies like a United Health Group, which has been in our portfolio for a number of years. This is a company that yields about 1.3%. And for that reason, it does not make it into many dividend strategies. But this is also a company that has annualized about 30% dividend growth over the last 5 years. So it's been a tremendous total return play. It's been one of our top performers year in and year out, and I think it's a prime example of why we focus more on total return as opposed to just yield. The other thing that I think really sets us apart is our lack of rules around dividend history. This is extremely prevalent when you're looking at ETFs, almost by nature, but I was surprised to see how many active managers actually have restrictions on companies that can be included in their investable universe based on dividend history. We're all familiar with the aristocrat model, which requires 25 consecutive years of dividend growth, and we've seen everything in between, 5 years, 10 years of required dividend growth before a company will be considered for inclusion in a portfolio. We do not subscribe to that. In fact, half of our portfolio is invested in companies that have less than 10 years of dividend growth history. We have a track record of investing in companies that have recently initiated dividends. In fact, I think Apple would probably be the most obvious example of this. We initiated a position in Apple shortly after the initiation of their dividend in 2012. And when you think about it, I don't think anybody would question Apple's ability to pay a dividend, or at this point their willingness to grow the dividend, just given the amount of cash that they have on the balance sheet and their ability to do so. But if you have a 10-year rule, you cannot invest in Apple until 2022, which just seems absurd to us. So, I think our ability and willingness to invest in below market yielders and recent dividend initiators allows us a better universe to choose from, which allows us to identify better dividend growth opportunities. But more importantly, I think it's also allowed us to position the portfolio in a more optimal manner in certain market environments, including the market environments that we're currently in. When we look at the last 10 years or the last 5 years in particular, the equity markets have had a very strong run, and it has predominantly been led by a handful or certain segments of the market that have seen a significant increase in valuation. We've just had our first negative year in the last decade, so we had 9 consecutive years of positive returns for the S&P 500, which has only happened one other time, and that was back in the 90s. And so the last 10 years have been uncharacteristically good for the equity markets and have had very, very low levels of volatility. and that is pretty typical. This slide right here actually kind of highlights the last 5 years, and non-dividend payers have been the biggest beneficiary over the last 10 years, and in this slide, the last 5 years of multiple expansion. They have contributed the most. You can see on the right-hand side here, that green line is really highlighting the premium at which non-dividend paying stocks are trading at relative to the S&P 500. And you can see over the last 5 years that premium has continued to increase. If this slide were to be updated today, I think we're probably close to a 48% premium to the S&P 500 for non-dividend paying stocks, which is well above the 5-year average of 35%. So they've actually continued to see multiple expansion, even though that they have been the biggest contributor to the increase in the valuation of the equity markets over the last 10 years. When we look at the annualized return for the S&P 500 over the last 10 years, it's currently about 13%, but non-dividend payers have actually annualized about 19% over the last 10 years. So they've actually outperformed on an annualized basis by about 6% a year over the S&P 500. So they have definitely been a primary driver of equity returns over the last decade. And a lot of that has come from an increase in valuation, which has also propped up the overall valuation of the S&P 500 as a whole. In contrast, dividend-paying stocks have actually gone down in value relative to the S&P 500. So the relative valuation looks much more attractive for dividend-paying stocks, as noted by the green line on the left-hand side of this slide. And they're currently trading at about a 6 or 7% discount to the S&P 500, where they've traded at about a 4.5% discount to the S&P 500 over the last 5 years. And so they look much more attractively valued than your non-dividend payers. But I would also argue that not all dividend payers are the same. In fact, you have seen some of the highest yielding segments of the dividend payers actually trading at pretty high premiums. And this slide, I think, illustrates that very, very well. This actually looks at the top 20% of the highest yielding stocks in the S&P 500 and actually compares the forward PE of those stocks to the highest dividend growers in the S&P 500. And the data is from Ned Davis, and it goes back to 1983, but you can see that on average, dividend growth stocks, or the high dividend growth stocks, have commanded about a 21% premium to the high dividend yielders. And then this is to be expected. You're paying a premium for that growth. But this started to change right around 2010, and high dividend yielders, for the most part, over the last 8 years, have been trading at a premium to high dividend growers. And this coincides with monetary policy. In a low interest rate environment, investors have been showing a tremendous willingness to pay a premium for yield. And this is something that we don't think is sustainable and is likely to mean revert. But where this causes an issue is for those managers that I alluded to earlier that have an emphasis on yield or a bias towards yield. Because as a manager, if I'm targeting a 4% yield or a 5% yield in this environment, it's becoming much more difficult every year that this occurs to maintain that yield bias. Because as the prices of these high-yielding stocks go up, the yields come down, and it makes it harder for me to maintain my yield bias. And so what we've noticed is that most dividend managers that have a yield bias have some of the largest allocations that they've ever had to bond proxy sectors like utilities, consumer staples, real estate, a lot of old telecommunications companies. And this has essentially forced them to forego future earnings growth of their portfolios and increase the payout ratios to maintain this yield bias. But at the same time, they're also increasing the interest rate sensitivity of the portfolio at the exact same time when interest rates are going up. So again, I think the flexibility of the dividend growth strategy or focus on total return allows us to position the portfolio and not get caught in these traps that managers that overly focus on yield are being stuck in. Historically speaking, we've probably had about a 1% yield advantage over the S&P 500. But if you look at our yield relative to the S&P over the last 5 years, you'll notice that it has actually come down. It's probably been closer to about a 50 basis point advantage. And I would argue that a lot of that has to do with our bottom-up fundamental analysis and not identifying a lot of attractive valuations or earnings growth in some of the higher-yielding segments. And so that flexibility has really allowed us to mitigate some of these value traps and not chase yield. And I think that's allowed us to position the portfolio optimally for this current market environment that we're in right now. This, again, further illustrates slide 9 here, the impact of non-dividend payers from over the last 5 years. The amount of multiple expansion that they have received, and what that impact has had on the overall S&P 500. So, the fact that we're not investing in non-dividend paying stocks has really allowed us to mitigate some of our valuation concerns, but also are not chasing yield in some of the higher yielding segments of the dividend paying world has also allowed us to really avoid some value traps and mitigate some of the valuation concerns you've seen in the overall market. So here you can see the dark green line is our dividend growth portfolio, which is currently trading right in line roughly with the S&P 500, but has been at a discount to the S&P over the last several years. And historically speaking, if you go back longer term, our strategy is traded at a slight premium to the S&P. So the flexibility of our portfolio, the willingness to invest in below market yielders and not chase yield, and the willingness and the ability to invest in recent dividend initiators has allowed us to, I think, position the portfolio optimally over the last several years, and really allow us to position the portfolio for what we think is going to occur going forward. The last 5 years have been very, very strong and have been characterized by a lot of multiple expansion, but we truly feel that we are now entering the later stages of the business cycle. And typically when you hit the later stages of the business cycle, you shift from multiple expansion as the primary driver of equity returns to earnings growth and fundamentals and valuations taking leadership as the major focus of what drives equity returns. And from that standpoint, based on our research, typically in the later stages of a business cycle, dividend payers, and in particular dividend growth stocks, are the best performing segment in the later stages of a business cycle. They significantly have outperformed not only the S&P, but in particular non-dividend payers. And this is because usually the non-dividend payers are trading at significant multiples as you enter the later stages of a business cycle, and this transition to fundamentals usually does not favor that. But what's, I think, more important is that when you do run into spikes in volatility, market pullbacks, or the eventual next recession, dividend payers, and in particular dividend growth stocks, provide the best level of downside protection, while your non-dividend payers are usually the worst performing segment. So we just feel that even though dividend growth portfolio is I think, an optimal starting place as a core equity position, because it gives you really good risk-adjusted returns that you can create a good portfolio for really any client. It makes particularly good sense in the later stages of a business cycle as a way to participate in the equity markets in a meaningful way by capturing a significant amount of the upside, but also remaining extremely well-positioned when you do run into spikes in volatility, market pullbacks, market corrections, or as I mentioned, is the eventual next recession. As I mentioned, most of our excess return has been achieved through capital preservation. We've generated a lot of our alpha through downside capture, and that usually corresponds with spikes in volatility. But I don't want to give the impression that it has to be a negative quarter or a negative year for us to generate excess returns. As you can see here, we've highlighted some of the more recent years where you've seen significant spikes in volatility. You have 2007, 2008, 2011, and more recently 2018. But not all of these were negative years, right? I mean, 2007, 2011 were years that were positive for the S&P 500. However, there was significant volatility, and those were both years where we generated a lot of excess return. Clearly, you have 2008, which also saw a significant spike in the VIX. We all know what happened that year, and again, the dividend growth strategy was able to provide a lot of downside protection that year and really generate a lot of excess return. And then most recently in 2018, there was more of a sector rotation story there in the fourth quarter. But again, by participating in a meaningful way in the first 9 months of the year, on the upside, and really limiting downside in the fourth quarter, we were able to outperform and generate some excess return through downside protection. So again, the strategy has really achieved in what it's set out to do, and I think it's optimally positioned for the current market environment as a way to get really good core equity exposure in a very risk-efficient manner. And allow you to participate in a meaningful way in the equity markets while remaining well-positioned for any spikes in volatility that we are likely to run into as you head into the later stages of the business cycle. So, I think with that, I'm more than happy to turn it over to any questions that you guys have, and as always, feel free to reach out to any of us here at Santa Barbara. We're always a resource, happy to travel, jump on calls, answer questions. So please feel free to utilize us as a resource and reach out to us whenever you have any questions. But I'll turn it back over to Patrick for any questions.
Great. Thanks so much, Eric. Really appreciate that. Quick question here on our end. Where do you think this dividend grower strategy really fits within an overall portfolio?
That's a great question. I truly believe that because this is a very well-diversified strategy that is focusing on dividend growth stocks, which are historically known to be very, very high-quality companies, that this is a great core equity allocation for just about anybody that you can build around. Because you are starting with optimal risk-adjusted returns within the equity market, I think this is a great starting point that even if you have clients that have much higher return objectives with a higher risk tolerance, you could pair a high-octane large growth manager or some other growth-oriented strategies with this and really achieve a good portfolio. If you have more conservative clients, I think this is a great way to get your conservative equity exposure that you could further reduce the risk by other asset allocation. So I think it's really just a great core equity allocation. But I, again, think it makes particularly good sense for individuals in the later stages of the business cycle, which we believe we're in right now, because you're focusing on companies that typically have capital advantages over their peer group. And as you enter the later stages of the business cycle, you tend to get increases in the cost of capital, which will compress margins for a lot of the lower quality companies. And so it allows an opportunity for companies that have that capital advantage to command a premium in the marketplace. And so we think that this is extremely well positioned for this stage of the business cycle as a way to really participate in the equity markets and limit downside as you run into pockets of volatility and corrections.
Fantastic. Eric, no more questions on our end. Thank you very much for your time today. Really appreciate that.
Thank you, Patrick. Appreciate it.